Real estate investing deal analysis. In my opinion, it's one of the most important skill sets that you can develop in real estate investing. Honestly, your number one priority should be finding great investment opportunities. Like if you're a if you're a wholesaler, your goal is to find great investment opportunities to sell to someone else. If you are a bird dog, you're finding great investment opportunities other people have put together and connecting it to the right buyer. If you are a buyer of real estate, you want to be able to buy some of the best deals out there, put your money to work at the highest possible level for you. If you're a lender, you want to invest in some of the best investment opportunities out there so you can get better returns and also more security with your investing. So if you're part of real estate investing at all, in my opinion, the number one job for you is to clearly understand how to find great investment opportunities. Well, how do you do that? You really only need two things to have great investment opportunities. You need to know how and where to find deals, right? Potential investment opportunities. And then you need to be able to analyze those to determine which of them are actually good, right? So I'm going to get into some training for you so you can learn how to do that and how to differentiate, because it's really important that if you want to be financially free through real estate, you understand the various benefits of real estate investing. You understand how you put your money to work for the best investment opportunities. And it's imperative that you understand three things that deal analysis can do for you. It clearly tells you, is this a good deal or not, right? Is this something that even hits your minimum investing criteria? It also helps you decide, of the multiple good opportunities that I have in front of me, which one is the best one for me to put my money into? Which one will get me the highest return on my investment, or in real estate, cash on cash return? Additionally, right, helps you filter out what's even a good deal, which of the good deals you should actually put your money into, which ones should you actually buy because they're the best ones, and which management strategy should you implement in a property? Should you invest more money to renovate it, to furnish it, to do something more advanced like a midterm rental, short-term rental, or co-living rent by the room strategy? Or should you leave it as a long-term rental? That's what deal analysis does for you. What's a good deal? Of the good deals, which ones are the best ones to buy? And what strategy should you implement at that property? Let me share some slides with you that'll help you kind of understand this, because you really need to understand clearly the various benefits of real estate investing, how cash flow is what dictates your financial freedom, but there are a ton of other benefits to investing in real estate, as well as review some sample analysis. I'm also going to show you the tool that I built and use every single day and thousands of other investors use to do all of those things that I mentioned. Is it a good deal? Is the best investment opportunity for me? How should I manage this property? The way you're able to do that all on one tool, which I don't think anyone else has out there, the ability to do that, is because it makes deal analysis an absolute breeze. It makes it easy for you to compare. Should you buy a property cash, traditional, creatively financed? If it's creative, how should you structure it? It allows you to compare the various management strategies. How much income will I get as a long-term, mid-term, short-term, or co-living rental? How much more money do I have to invest in the deal to get it ready for that? And then is my overall cash flow, is my overall monthly profit, does that justify the extra money I have to put into the investment? For those of you who are full-on super investors who have the full super investor real estate calculator, you also get a ton of additional benefits on the calculator. It allows you to analyze your deals over much longer time periods, not just the first year. It allows you to see, if I was going to raise money, if I was going to bring in a capital partner, someone who's either a private money partner who co-owns the asset with me, or if someone is a private money lender who's lending me money for a fixed interest rate return, what could I offer them to still make the deal make sense? And not only that, if I offer them 50% ownership, what does that mean for them? How much money are they making? What is their share of appreciation, debt pay down, tax benefits? What is their specific cash on cash return for the amount of money that they're investing with me? Taking that information, putting it into a dedicated section that outlines very clearly what your capital partner will receive in terms of return. So you could just screenshot that and put it with your capital raising marketing. This is what I mean by the Super Investor Real Estate Calculator makes analysis a breeze, but more so allows you to compare the various ways to buy the investment, and if it's worthwhile to manage it differently, right? So we're going to get into that. I'm going to show you how to do that with a sample deal, and I'm going to show you how you can compare briefly if it's cash, creative, traditional, which of those makes sense. How do you analyze this on this calculator? If you want a free copy of the calculator, I'll show you how to grab a link or how to grab the link for that, or you just drop a comment down below and let me know you want it, and we'll make sure to send it to you. Okay, so with that, let me share a couple slides. So it's important that you clearly understand the various benefits of real estate investing. The most common one, which is what we will be breaking down in just a few upcoming slides, is cash flow. Cash flow is your income minus your expenses minus your reserves. It's what you are taking home at the end of the month or at the end of the year, however you want to consider it. And that money that you're receiving, that is what actually makes you financially free. That money, whatever you had to invest to buy the deal, to get it operational, and then to generate that cash flow is what makes you free. That is what's going to cover your lifestyle, whether it's $5,000, $10,000, $20,000, however much you want coming in monthly. That is what's going to make you financially free, and you're going to have the freedom to work from anywhere if you choose to work, live anywhere, do whatever you want with your time, have total control of your time, which in my opinion, for those of us who are working extremely hard as investors, that's the ultimate goal. For some people, it's very materialistic, right? Like, hey, I want to be able to buy really amazing cars and watches and all that. There's actually nothing wrong with that. That's what you want. That's cool. You can totally have that. And you still need to understand how much cash flow you're generating to be able to cover those expenses. But for the majority of people I talk to, you are doing this whole thing because you want time, financial, and location freedom. You want to be able to do what you want, wherever you want to do it from, whenever you want to do it, with whoever you want to do it with. Like, you want freedom to do literally whatever you want with your life. And that's the beauty. Once you're financially free through real estate, you can pursue whatever you actually care about without worrying about how am I going to continue to pay my bills if I no longer have a job. We don't have to worry about that because you're financially free now through real estate, the cash flow generated from that real estate. There's other benefits of real estate, right? When you buy a property, as we've seen, prices continue to go up. That is appreciation. Property values go up over time. That adds to your net worth. As your property goes from $500,000 to $600,000, you have $100,000 more net worth. If you chose to sell or tap into that by doing a refinance, you have more money you can pull out tax-free or sell and receive that money that you can live, that you can do whatever you want with. But that's appreciation. Your property goes up in value over time. Simultaneously, not only is your property going from $500,000 to $600,000, well, every single month, your tenants are paying you their rent, you're paying down your debts, and you keep the leftover as your cash flow. Well, that debt pay down is coming from your tenants. They are paying down your loans on your behalf. So not only is your property going from $500,000 to $600,000, but your loan of $500,000 is now worth $400,000. Those two things, the appreciation and debt pay down, is adding to your net worth, adding equity, right? Equity between property value minus your all-in debts, right? If you were to sell it, like, what, that is a huge benefit. That's a huge ownership benefit. Sometimes that is overlooked by lots of people, but it's important to consider those factors. But the number one thing you should focus on is cash flow. And we'll talk about cash on cash return, which is showing you not just how much are you making each month, but more importantly, how hard is your money working for you that you had to invest to get that property operational. Additionally, what helps you with your financial freedom is your tax savings. Through real estate investing, you get a variety of tools to save money on taxes. This is really important because making $100,000 at your job, that's going to be taxed. That's going to end up being $60,000, $70,000, $80,000, right? By the time it's all said and done. When you're making money through real estate, you're keeping most, if not all of that money with paying little to no actual taxes. You make $100,000, you keep $100,000. And the fifth benefit I include here is leverage, right? You get to use debts, other people's money. As you get more and more knowledgeable and more experience, you get to leverage your momentum to be able to buy more deals, better deals, raise more money to get more deals. Real estate investing, as you do more, starts benefiting your ability to do more deals and better deals. So if you take anything away from this, what makes you financially free is the cash flow, and the tax savings help you keep more of your money. Ownership benefits like appreciation and debt pay down, they are very important, but they don't make you financially free. What they do is add a lot of equity, right? Add to your net worth. And when you choose to sell or refinance that property, you get to tap into that. But that's not what's going to make you financially free today. With that, here's a better financial freedom is accomplished when your cash flow coming from your assets, what you've invested in, exceeds your expenses. If you're spending $5,000 a month and now you're generating $5,000 a month in cash flow, you are financially free. For some people, that's too tight for me. So I wanted to get at least 2 times the amount that I'm spending each month so that if my lifestyle inflates, I will continue to be able to cover all my expenses. And just because you are financially free doesn't mean you have to stop working, but it's like such a different position when you are a financially free real estate investor and you know you can cover all of your expenses and then some, or if you're working a job and you're building your financial freedom, knowing that if something were to go wrong with your job, there was, you got fired, laid off, or whatever the situation is, or they put you into a corner that you were essentially forced to quit because you no longer align with it. It's important that you have that freedom, you have that cash flow coming in to leave a job if you choose to, or if you're forced to, and cover all your expenses regardless and continue building on that if you choose to work. That's the thing people get confused about. Being financially free doesn't mean you inherently have to retire. It just means now when you work on your own terms. You work on what you want, whenever you want, you stop whenever you want, you control your schedule, you decide who you're going to work with because you're no longer reliant on someone else paying your bills and things going wrong for you. You've invested in the assets. Something you might have heard me talk about is my Super Investor Blueprint. I'm not going to go too far into the weeds of that, but the core concept is creatively financed investments, capital raising, so using other people's money to buy those deals, and co-living so that you're maximizing the cash flow and ownership benefits, and you're able to buy much more deals because we're in the earlier stages of co-living versus other strategies. Imagine if you were someone who wanted to do short-term rentals. However, you're at the point in which short-term rentals are essentially dead. Those that are performing, like I have some really amazing properties that are short-term rentals, but those that are performing, you're not going to just go buy a basic house and have really solid returns with co-living, or you're not going to have really solid returns with short-term rentals, especially now. So short-term rentals are dead and dying, and returns are lower and lower, and it's getting harder and harder to own and manage them, both from the guest experience, but also from the regulatory side. Certain locations are making it more and more difficult to set up and manage your short-term rentals. You're going to have permits or limitations, restrictions, all that kind of stuff. All that being said, you can maximize your journey to financial freedom through creative finance, capital raising, and co-living, but it's not essential for you to understand or start real estate investing. Those are the more advanced tools I implement to be able to buy better deals at lower interest rates with less money, using none of my own money, and to maximize all of my cash flow and ownership benefits through the assets that I buy. It's the combination of creative, capital raising, and co-living that allows me to do that. All that is also for the emphasis of generating much more cash flow, so I'm able to be free with less properties, right? If you can get more returns per investment, like higher return per investment, that should be your goal. There's no point of trying to buy 100 properties that perform just as well as one does, right? Focus on buying the best deals and structuring the best deals, as opposed to just focusing on how can I buy as many deals, even if they're not great ones. That's where deal analysis is so vital. So with that, let me share. So let's talk about cash flow briefly before we get into the actual calculator and how you're going to do this for whatever acquisition or management strategy you're going to do. For most real estate investments, you're looking at your cash flow, right? Your income minus expenses minus reserves. How much money are you making every month on this property? And then you're looking at how much did it cost you to buy this property and get it operational, known as your entry costs. And you're taking those two values, the cash flow, but you're taking it for the year. So the annual cash flow, 12 times your monthly cash flow, divided by your entry costs. And that is telling you what is your cash on cash return. So now this is telling you how hard is your money working for you. This is how you differentiate between should I buy property A or property B, right? You still have to make sure first and foremost, property A and property B are deals that you would want to move forward with, but comparing cash on cash return is what allows you to make the determination, should I buy property A or property B? Because which one has a higher cash on cash return? Which one is getting you more cash flow relative to the amount of money you had to put in to get this investment done? Very simple for cash flow. Income is income. How much money are you generating? Expenses account for all of your debt payments, including the mortgage payment. If there's any additional debt payments, there's property mortgage insurance, if there's an HOA, if there's taxes, insurance, utilities, property management. And you're also subtracting away your reserves. This is the money that you are setting aside for things like vacancy. So when your property is not being rented, typically after a turnover or while you're waiting for a new tenant to move in, any maintenance that's going to come up, as well as capital expenditure. So this is, think of maintenance, but on the big stuff, the large expenses, the roof, the appliances, replacing the full flooring, doing a full paint job, painting the exterior, just bigger projects that you know are going to happen that you need to start saving for. If you don't account for that, you're going to be very surprised with substantially less money that you made than you thought you were going to make. As I mentioned, cash on cash return shows you how profitable your initial investment is. You'll see me utilize the term initial investment and entry costs very interchangeably. Pretty straightforward, right? Annual cash flow up on top, entry costs or initial investment down below to determine what your cash on cash return is. To increase your cash on cash return, you either increase your cash flow or lower your entry costs or initial investment. Your initial investment very clearly is the funds to acquire and set up your property, as well as cover the carrying costs. So the costs you have, the expenses you'll have while you're getting everything set up, and have some reserves set aside for your property. To see what that looks like in detail, and I'll show you how to do all of this on the calculator in just a few minutes, there are various components to the entry cost depending on how you're buying your deal. If you are, the various components to consider are cash to seller. So what is your down payment, whether it's on the loan or the money you're giving directly to the seller, depending on how you're buying it. There's any arrears they have to pay off, which is more common, or which is for creatively financed investments. So if you're buying a property, but a seller is behind on their mortgage, or they have liens on the property that need to get paid off, you might be the one who's responsible for paying those off to get the deal done. Any agent commissions, so if there's a real estate agent, whether it's yours or the seller's, you have to cover those costs. Like to some component, you're going to have to cover some of that or none of that, depending on how you negotiate. Similarly with closing costs, you're going to have to pay the title company, closing attorneys, whatever other costs are there with closing costs. Additionally, additional closing costs are your admin and reimbursement costs that you see me list here. So that's like for me setting up my LLC, getting an inspection done, getting a transaction coordinator done. The reason why I personally separate that and have it separate on the calculator is because a lot of the time as a real estate buyer, you're covering a lot of those costs, and the rest of the closing costs are done at the final day when you're actually closing on it. So you're covering these admin or reimbursement costs up front, and the remainder of the closing costs are done at closing. The reason why I separate it is because I raise money to buy my deals. I want to make sure that I'm getting my money back for some of the costs that I paid for up until the closing process. You also need to clearly understand what your renovation costs are, and if you're going to furnish the property, what those furnishing costs are. If you're buying a deal from a wholesaler, there's an assignment fee, right? You got to pay the wholesaler an assignment fee. If you are charging an acquisition fee, for example, let's say you have a bird dog in the deal who helped you find it, you're paying them for that, you can add that in the acquisition fee section. Or if you are getting paid up front for this deal, you account for that as well in the acquisition fee section. And then your carrying costs or your reserves are your carrying costs of the period in which you bought it, you're renovating it, and you're furnishing it, and it's getting listed for rent and is not fully rented yet, right? It's that period to get your property converted over and fully operational, generating your income. And then there's additional reserves. After that period, what additional reserves do you have set aside for if and when something goes wrong? There's a maintenance request, or it takes longer to, or it costs more to renovate the property, or takes longer to fill your property. You have non-paying tenants. You want to have some reserves set aside, and you'll continue to build on that based on the money you're setting aside for maintenance and CapEx. So you'll continue building on that throughout your ownership period. If you are buying properties leveraging a more advanced strategy, for example, co-living or rent by the room, the entry costs account for typically, this is a standard property. I'm buying it and I'm going to be doing some standard renovations, right? You buy it, you need to do some touch-up paint and whatever else to get it ready for a long-term rental, right? That's what I typically account for here for this renovations. But if I'm doing some specific additional entry costs to get it ready for a strategy, there's a separate section for that. So then you can clearly compare, should I buy this property? This is the comparison, right? If I buy this property because it's a good deal, should I manage it as a long-term rental, co-living, short-term rental, mid-term rental? We need to understand not only how much more income and expenses there will be, right? The cash flow, what's the difference in cash flow, but also how much more money will it cost you to renovate, furnish, and anything else you have to do for that property. For co-living, you have to account for the cost to build your additional rooms, the cost to furnish your rooms in the common areas. For short-term rentals and mid-term rentals, very similar. What is the cost to do any additional renovations? What is the cost to furnish the property? So let's get into the calculator. I'm going to show you some really great insights too for your deal analysis. So I'm showing you the calculator at the craziest level, just super zoomed out. There is so much on this first tab. Do not overthink it. Do not overworry about it, because I will show you how to simply go through the flow of this calculator so it makes the most sense for you. You just do it piece by piece. And so what we're going to start with is right here, property information. This is just a sample property. We're going to say it's a 4-bed, 3-bath, 2,180 square foot property. That doesn't matter for the sake of the analysis we're going to do. We're going to analyze for various strategies, but we'll see if co-living viable with 4 new rooms, right? So if you don't know if you don't understand a lot of the terms that I'm saying, I have plenty of videos going into this stuff in depth, but I want to show you how to actually utilize this calculator. The first thing you're going to do is focus on your debt and your entry costs, right? So let's talk about that. When you go to the calculator for the debt, you can choose to buy your property a variety of ways. You can buy it cash. So this is a $400,000 property. If you were to buy it cash, just click cash and it'll automatically say your down payment is the full $400,000. If you're buying a $400,000 property, you are paying the full $400,000. There is no loan, right? That also adds to the down payment or cash to seller section in the entry costs. Additionally, you have other entry costs to account for, saying that your total entry cost for this deal is $433,850. That is your total entry cost if you were to not make any additional, if there was no additional entry costs for a specific management strategy, right? So you could quite literally you could already analyze, just with that alone, your long-term rental. Assuming the rental income is $2,450, you think you get it to $2,700 in the future, but that's what it's currently renting for, is $2,450. You have your fixed expenses, which are right here, which is just your debt payments, which there are none, so it's zeroed out. Property taxes, insurance, if there's mortgage insurance or an HOA, you're buying cash, no PMI, and there might be an HOA, right? But it's just your debt payments, taxes, and insurance. There will be additional expenses per strategy or what you are choosing to cover for your tenants. For example, for long-term rental, if you choose to cover the utilities, that's there, right? There's also management, vacancy, maintenance, and CapEx, but that's all dependent on your management strategy and the amount of income your property generates. These are typically percentages of your total income, is how you're deciding how much money goes to these things. If you were to do co-living, for example, right here, it shows you, okay, it would be $26,000 more to build these 4 rooms. How? Because you're estimating $6,500 to build a room, and you have 4 additional ones, so it's $26,000. You're estimating $1,200 per room to furnish the property. A lot of that is going to go towards furnishing the rooms, but that's also going to leave some money left over for the common areas. So if you're going to furnish the kitchen, if there's a living room, outdoor space, it's going to have some money set aside for that as well. This is how you are initially analyzing an investment to decide, should you proceed forward with it or not, using some estimations. The more you understand a market, the more deals that you've done, the more clear you will get on how much is going to be the renovation, how much is going to be the furnishings. This is just their initial starting place to estimate that. And then we'll get into the income and all that stuff as we talk about different strategies. But for this, like the different expenses, management for each of these different ones, I'd say how to renegotiate, but there really isn't besides buying it at a lower price. But it looks like there's no scenario in which this makes sense. For a long-term rental, even though this property would be generating $1,400 a month in cash flow, which far exceeds your cash flow goal, it's not a great investment. How do I know that? Because your cash on cash return is extremely low. You're putting in total for this long-term rental, $433,850 to buy a property that generates you $1,400 a month of cash flow, or $16,968 a year in cash flow. You take that and divide it by your $433,000. It is clearly telling you your cash on cash return is 3.9%. Your return, the cash flow you're generating for that entry, is less than 4%. You're better off just putting that money in a bank account, a high yield savings account, and getting roughly that 4% return, or putting in the stock market for that 7, 8, 9% return, right? As opposed to getting low returns with way more work involved and a ton of money invested. This is why cash usually doesn't make a lot of sense. Sure, you're maximizing your cash flow because there's no debt payment, but it doesn't make a lot of sense because you're putting in so much money. This is telling you the cash on cash return is really low, right? It's not a good investment for you to even move forward with as is. Okay, cool. Well, let's see if you were to buy it using traditional financing. If you were to buy this property using traditional financing, so a 25% down payment option, right? That's $100,000 down payment, leaving you with a $300,000 loan. All you did was set your purchase price. You select the traditional DSCR, like the traditional loan type. It'll automatically put in 25%. If you are getting a loan at 15%, 20%, whatever, put that in there, and this will automatically tell you what that down payment dollar amount is, and then tell you what is the remainder for that loan amount. This will also put in some interest rates based on what kind of the local market averages are. And right now it's around 7.5% for a DSCR loan. So a loan of $300,000 at 7.5% interest rate, amortized over 30 years, is a payment of almost $2,100 a month for the loan. There's still the other fixed expenses like taxes and insurance, right? And the biggest impact on your entry cost, instead of putting $400,000 here, as you did with cash, it's $100,000. Everything else in this example is assumed fixed. So let's see if you're generating any cash flow. I would assume not, because your debt is already so high. This is the problem with new loans a lot of the time, especially with long-term rentals. You can't really make a lot of deals work at 7.5% interest rate as a long-term rental. It's few and far between, and the ones that make the most sense for that are really cheapo properties, which are also diminishing your overall wealth benefits of real estate, minimizing your appreciation and debt pay down. And even the cash flow you generate on a $100,000 property is what? Maybe $100. Is that even worth all the time and effort? Most people wouldn't think so. And there's management headaches with that kind of property, which we won't get into either. So in this example, zoom in a little bit more. Your entry costs are lower and your cash flow is also lower because you have the same rental income, but your fixed expenses alone are $2,450. Then you have your management, vacancy, maintenance, and CapEx. Well, that's $3,134, right? That's way more expenses and reserves than your income. So your cash flow is substantially lower. I hope you're clearly understanding why, because instead of putting $400,000 to buy the property cash with no loan, now you have a loan and you're able to put less money in. But because this number is negative, it doesn't matter what your entry cost was, even that it's substantially lower, because if you have negative cash flow, it's never a good investment to put your money into a deal. This is where you start now looking at, okay, maybe it doesn't work as a long-term rental. Does this work for other management strategies, right? I mentioned your goal is to figure out what are good deals, how should you fund those deals, like what type of loans you should use to buy those deals, and what strategy should you implement to buy that property? Well, this already tells you what is the highest and best use strategy, assuming a lot of things, right? Like assuming all these numbers are accurate, which you're gonna have to update every single time that you're analyzing a deal. But because like this income, it doesn't know, this isn't specific income for this property. It's just income in general that was just put in here. You have to update this information. But assuming this 4-bedroom property, you're adding 4 more rooms, that's $26,000 for renovations. It's going to be $9,600 for furnishings. Your entry cost has gone from $140,000 to $175,000. If it costs you $10,000 to build the rooms, you add that here as well, right? You add your best estimate or leverage what I have there and then get a contractor in there to actually confirm these numbers or provide you the more accurate number. Your income, so depending on what your income is for the property, right? How many of them have private bathrooms versus shared bathrooms, and how many of them, and like what is the weekly rate for that property, right? And I've done plenty of videos on how to get that for co-living, leveraging various tools that I like to leverage. And I'm going in depth into that as well at my upcoming co-living workshop. This is telling you what your property income would be weekly and then what the monthly income would be. It already tells you that. You just update the number of rooms and the income per room type. You add your expenses, your fixed expenses already carried over from the top. We're adding an additional $100 of insurance cost a month because you're doing a more advanced strategy. Typically, you're going to be paying more for insurance for co-living, short-term rental, mid-term rental, because it's furnished and you have, a higher turnover of tenants, different, you're mixing different tenant types in there. You're covering utilities for this strategy. So whatever your costs are in your market, if you're leveraging the PadSplit property management platform, the PadSplit platform in general, the fees for that, fees if you're paying a property manager outside of that to do that, or if you're just going to do no PadSplit and you're going to pay your own property manager 15%, you can quickly just enter that stuff and it automatically runs it for you. The money set aside for vacancy, the money set aside for maintenance and CapEx. And you'll see as a co-living rental, your income is substantially higher, right? Let's clarify. You put in $35,000 more dollars, right here. You put in $35,600 more dollars to get it ready for co-living. So your entry costs are higher. Additionally, your income is higher, but also so are your expenses. When we looked at it, your income was $2,450 as a long-term rental. Your entry cost was $140 instead of $175, but now your income as a co-living rental is $6,110. Your expenses were substantially lower. Your total expense and reserves were $3,134 as a long-term rental. Because there are more expenses and reserves, your total expense and reserves now are $5,142. So we're just taking those values, your income minus your expenses, management, and reserves, and that is your cash flow. You're taking that cash flow and you're multiplying by 12, right? Your annual cash flow, and dividing that by your newer, higher entry cost. It's all done for you. It's telling you your cash on cash return for this investment is 6.6%. We can look at other strategies as well. You could do the same for midterm rental. You do the same for short-term rental and then compare which ones are the best, or you fill it out and this will tell you quite immediately. It'll tell you what is the best strategy based on what provides you the highest cash on cash return, assuming you've inputted all those values. Then you just select for your long-term analysis, which of these strategies do I want to implement to do all of my long-term analysis, my capital raising, all that stuff, which we'll get into shortly. I want to finish up the debt stuff. So this is really telling me long-term rental, co-living, whatever, buying a property at 7.5% interest rate and a 25% down payment is not going to work for me. The problem with that is there's very little you can do with a traditional loan to make it better. One of the things you can do is lower your interest rate by paying points. You can reduce this interest rate by paying more closing costs. And I don't have great numbers for you. It's really going to depend on the loan and what the terms are at that moment. But if we just add, let's say your closing costs now are instead of 2% or 3%, let's do 4%, right? It's another 8K here. And this goes down from 7.5% to 6.5%. So the question is, was that worth it? Did that make it a better deal? Because your cash flow went up because your loan went down, but your entry cost also went up. I would assume this is actually a better cash on cash return. You have to always analyze that to see if it's worthwhile to do. You'll ask, should I use this strategy? Well, I can't tell you. What is the change in your cash flow? What is the change in your entry cost? Therefore, what is the change in your cash on cash return? Was that a good investment of your money? Put more money in to get more cash flow. Was that a good investment? It's ultimately up to the numbers, but I'm going to make an assumption that it was in this scenario. So I'm from 6.6 to 7.7%, right? Understand that that is fairly limited, right? Like, I don't know how much you can drop this interest rate. It's really going to depend on your lender and how competitive interest rates are and what happens to the market and interest rates, all that kind of stuff. But the reason why traditional or DSCR loans are tough is because you have very little wiggle room to negotiate anything. It's, I can give you some more money to lower the interest rate, which will lower your debt payment, which will increase your cash flow, right? You're decreasing your expense by putting more money up front, which is increasing your cash flow at the cost of putting more money up front. Is that worth it or not? Look at the cash on cash return. What do the numbers say? All right. So now if we were to do this as a seller finance loan, so instead of doing it where you are going to a bank for a loan, let's say the seller owns the property outright, right? And now they're acting as the bank, which means not only is the purchase price negotiable, which is something you can always negotiate on any investment. So actually, I can quickly show you what that would have looked like. In this scenario, what would you have, like, if you reduce the purchase price, at what point would it become a good deal? So you have to select what management strategy you want it to consider right here. But then it'll tell you, if you're able to reduce the purchase price, at what point does it become a good deal? Well, it hits your cash flow and cash on cash return goals if you lower the purchase price to $240,000, right? That's a 40% decrease, which is not going to happen. But that means lower purchase price, which means lower down payment, lower loan payments, right? So that will tell you at what point does that make sense for you? Or if you were to reduce the interest rate, at what point does that make sense? Well, even if you go down to 3%, it still doesn't make sense because your cash on cash return is not hitting, in this instance, your 15% cash on cash return goal. This is the automatic deal analysis, like automatic renegotiation of a deal. This is doing that for you in real time, telling you, and it's like, is this viable? I don't think I'm going to reduce it 40% of what they're trying to buy. I can move on. Like, it's not going to be a good investment. There's not a lot that we can do here. All right, with that, let's see about seller financing, where it's not just the purchase price, it's the down payment, right? How much down payment, what the interest rate is on that loan, if there is payments for, the first couple months, the first year, all that kind of stuff. So with seller financing, you'll see, this is automatically setting a 10% down payment. Does that mean that's what your seller finance deal is going to be? No. I've got properties that I've bought seller finance with even substantially less than 10%. Sometimes as low as $5,000, $10,000, $20,000 down to buy that deal. This also sets your seller finance interest rate at 3%. Does that mean that you're going to buy your seller finance property with a 3% interest rate? No. You have to plug in the real numbers. It's just giving you some preset numbers to work with, right? That's why it's highlighted pink. And you'll see on the key, replace these values, right? If that's accurate, if you're doing a 10% down payment, 3% interest rate seller finance loan, well, okay, that works. But that's coincidence, right? So the seller finance loan, same purchase price, same everything else. The thing that changes, your down payment is lower. Because your down payment is lower, your loan amount is higher, but your loan is also dependent on your interest rate, right? So if it's a $400,000 purchase price, if you're buying it cash, you're paying that whole $400,000, there's no loan. If you're buying it with a 25% down payment or $100,000 down, it's a $300,000 loan. Buying it with 10% down or $40,000 down payment, well, that's a $360,000 loan. Simply, your down payment goes up, your loan amount goes, if your down payment goes down, your loan amount goes up, right? That's very straightforward math. In this instance, we could see, does this deal make sense just based on having it seller finance instead of traditional? With a lower down payment, even though it's increasing my loan amount, right? But it's reducing my entry cost substantially than it was before by $60,000. Does that change? And the change in my loan payments, does that make it worthwhile? We can very quickly see between long-term rent, even as a long-term rental with 10% down and substantially lower entry cost, it's still negative cash flow. Even in this instance, it's still negative cash flow. Once again, if it's negative, your cash on cash return will be negative. So you lowered your entry costs, but it didn't matter because the cash flow is still negative, right? If this was positive 100, this would have a bigger impact than it would have. The entry costs, like, do not do that. Do not hard code that. That'd be disingenuous. But your cash on cash return, because the entry cost is lower, having a lower increase in cash flow would still be more beneficial for you. Like, it would have a higher cash on cash return, even if it only went up 100 or 200 bucks. As a co-living rental, we went from around a 6.6%, or it was a 7% once we reduced it from 7.5% to 6.5%. But your entry cost went from like 170 to 118, right? Everything is fixed except for this down payment. And even though your loan amount went up because you're putting less down, because it's substantially lower interest rate, not only is your entry cost lower, but your monthly payment went from close to $2,000 to around $1,500, adding several hundred more dollars a month to your cash flow, right? Several $100 less in expenses, which means income minus same income minus lower expenses minus same reserves is more cash flow. So everything else was fixed. So the only difference is the fixed expenses, which is just changing by your debt amount. You're generating $1,548 in cash flow. I don't remember exactly what it was. I actually have a chart that we can look at and comparing everything right afterwards. So you're going up by $700 or $600 roughly in cash flow, and your cash on cash return is going up substantially from 968 or 6.5% to 15.7%, making this a great deal. This will still also tell you automatically at what point, like, what would it look like if you reduce the purchase price and the corresponding down payment, right? Assuming it's still a 10%. What would the deal look like automatically based on the strategy you selected? What would your new cash flow be? What would your new cash on cash return be? Because just because it makes sense like this doesn't mean you can't continue to negotiate, try to make it better, right? Same with if you lower the interest rate, what would have a bigger impact? This is how I clearly decide, should I focus on lowering my purchase price and my corresponding down payment, or should I focus on lowering my interest rate? I can, with 99.9% certainty, say lowering the interest rate on seller financing tends to be a better option than just focusing on the purchase price or down payment. It's going to depend. There's a few edge cases, but usually lowering the interest rate is the best thing you could do. Not only is that reducing your debt payment, right, which is increasing your cash flow without compromising your entry costs, without having a corresponding increase in entry costs, but it's also because it's a lower interest rate than it would be otherwise, you're also getting better wealth benefits. So for example, this is showing you 1, 5, 10, and 20-year projections for appreciation, debt pay down, and tax benefits. Well, if you, like, the property is the same property, it's going to appreciate the same amount. The cash flow is going to change based on what strategy you implement and how you acquire the deal, right? If you're making more cash flow, it's going to be accounted for here. Lower interest rate means more cash flow. Just very quickly, it's 18,578. If we reduce this to 2%, right? This went down a couple $100. Now it's 20,000. So you're getting around $2,000 more of cash flow for the year. I'm going to keep it at 3%. But more importantly, as I mentioned, the wealth benefit, it's not just from properties increasing in value, it's also your debts being paid down. The advantage of seller financing is that if it's a lower interest rate, less of your money is being wasted on interest, more of it is paying down the debt. How do you see that visually? When you have a loan, this is assuming a 6/1 start date, so we could change that. It doesn't really matter. It's assuming you bought it 6/1/2025, whenever you decide to buy it. Your loan payment on the way mortgage loans are set up is your loan payment will always be the same amount every single month. However, at the very beginning of your loan, the majority of your payment will go towards interest. Like, the most you ever pay towards interest will be at the very first month. And the least amount you'll paying down the actual loan debt, the principal of the loan, paying down the balance, will be at its lowest each month. Every single month that you proceed forward, less is going towards interest, more is going towards principal, even though your payment is fixed. This is where I'll talk about with a sub-2 deal. When you're buying someone's deal that's already 5 years into the loan, well, you're already at a period in which you're already paying down more debt than you are interest, right? You're already paying $696 towards principal instead of $617. So every month it's an extra $80 and then adding to that because you're further into the loan. This chart shows you that, right? Your loan principal is the same or the loan payment is the same every month, but at the beginning you have more is going towards interest, less is going towards principal. Every month the principal amount is going up, every month the interest amount is going down. Understanding that the lower your interest rate, the bigger the spread, or the closer the spread is. For example, if we looked at the very same investment, this is if you were capital raising, we'll get to that. If we look at the very same investment at the 7.5% traditional, we'll look at how much longer the substantial difference in how much is going towards principal and interest. So not only is your payment higher, but a massive amount more is going towards interest every month and also over the lifetime of the loan versus the principal. And it takes much longer where this inflection point occurs, where you are paying more towards principal and less towards interest. Where that occurs, where that changeover occurs, it's further and further out because your interest rate is higher. Interest rate is lower. This happens sooner, if not immediately. And you're paying less towards interest and more towards principal from the very beginning and every month moving forward as well. Like just looking at this, look at this spread. Your first payment, $1,875 is going towards interest, $222 is going towards principal. That's crazy. You're literally just paying insane amounts of interest. So not only are you getting more cash flow and a higher cash on cash return, you're also paying down your debt substantially faster. You can see that very quickly. And we'll do debt pay down over like 10 years. It's $59,161 for a traditional at the 10-year mark. So $59,000. If it was seller finance at 3%, you've paid $82,000, almost $83,000 in debt. So $30,000 additional added to your net worth through paying down your debts, but also way more cash flow during that whole period as well. Substantially more cash flow. And also having properties that you buy with great debt in place gives you more exit options. You can sell this to other people more easily because you have great debt in place. This is why I mentioned the super strategy, like the super investor strategy. Creative financing is so important because I like to buy properties with less money. So instead of $140,000, it's $82,000, or it was, let's see what it was. Instead of $180,000, it's $118,000. So roughly a $60,000 spread. That's basically my cost to go buy another half a property, right? So for every 2 I buy traditionally, I could buy 3 creatively. Not only are they're better deals, better cash flow, right? Higher cash on cash return, more debt pay down, more exit options, but also I can buy more of these properties. So I'm putting less into buying the deal itself. So not only am I getting better returns, I'm also able to buy more. So that means not only is my cash flow not comparable apples to apples, but it's also I'm going to be able to buy another property, generating even further cash flow with that same amount of money. That's a huge one. That's opportunity cost. That's why it's important to understand the difference between the cash on cash return and how you're buying deals and the various strategies. That's a key consideration. If we were to do so that's it. If you need to change the down payment, you can. Whether you change the dollar amount, right? You could just hard code the dollar amount. If it's 100,000, you could just say 100,000. If you wanted to see what this down payment was as a percentage, you just click equal, click the 100,000 divided by the 400,000. That tells you the percentage. Or you just change the percentage to, let's say it's still a 25% down payment, but it's 3% interest rate, right? Even that scenario with the same down payment is obviously going to be way better because your interest rate is way lower than it was as a traditional rental. It's not way better than if you put less down, even though your cash flow is up, right? Putting in more down, increasing your entry cost, did not make this a better deal than it would have if you put less down, right? A big part of that is because the interest is so low on this investment. So that's how you would adjust the seller finance. It's pretty much all you have to do. The one caveat is if there is a balloon on the loan. So let's say the seller is willing to finance it to you like this, in 30 years, the loan be paid off in full, but in 10 years, they want the loan to be paid off entirely, right? That's a balloon. In 10 years, they want it all paid off. Well, at the 10-year mark, assuming you started at 6/1/2025 with your first payment, you've paid down $85,000 of the loan, right? So your $360 loan amount, $85,000, pay down the loan. That leaves you at $273,000 left to pay off. Your interest payment that you paid over that time was $95,000. The total loan payment is saying, how much have you paid between the principal, interest, and the final loan payment? This is a good negotiating tool, telling the seller, hey, I know I'm buying it for $400,000. You're getting $40,000 up front. Well, this loan of $360,000, the reason why seller financing could work really well for you is because you're not going to get that much. You're going to get $454,000 over the next 10 years instead. That's giving you solid returns on your investment over almost $100,000 more than you would have gotten if I just paid you it all up front and took out a new loan. But this just lets you think about what your exit is going to be in the future. So if we did the exact opposite, which is subject to, which is, well, it's not the exact opposite, but subject to is you're buying a property and the seller's loan stays in place, right? So you're buying the property, you're giving some money to the seller, potentially, usually, and instead of taking out a new loan that will pay off their debt, or the seller owns it outright and they're financing like the bank is, what you're doing is you're taking over the responsibility of payments for their existing loan. This has much less negotiation than seller financing, because with seller financing, you can negotiate literally everything because the loan is already established. The advantage of sub 2 is you're going further into someone's amortization schedule, right? Your loan payments are more going towards principal than they would have if they started fresh today. This one is a 2022 loan, just random number, it could be any number, any start date for that loan. And you're taking over their 3% interest rate loan, right? In this scenario, you have the same $400,000 entry or purchase price. You're paying them their full amount of equity. So this is saying this loan originally in January 1st, 2022 was for $350,000 at 3% interest rate, and it would be paid off in full in 30 years, the amortization of the loan terms. That means your monthly payment on this loan is $1,475.61. That pulls into here. The amount of loan that you're taking over is not the full amount when they started. It's how much is left over. And as of 6/1/2025, there's $324,103 of loan amount that you're taking over, which means if it's a straight subject to deal where you're taking over their loan and you're giving them the cash for all the rest of their equity, that means you're giving them $75,897 up front, right? That's the difference. It's a $400,000 purchase price. You're taking over the $324,000 debt. This leaves around $76,000 that you're paying to the seller up front, which translates to around a 19% down payment for this loan type. How does this deal work, right? I'm going to tell you right now, I'm assuming that it is going to be worse than seller finance, because even though you're taking over, like your loan payment is lower, so you're making more cash flow, I think increasing this from $40,000 to $75,000 has a bigger impact on your cash on cash return. How do you know? Look at it, right? Look at what it looks like. Go down. Everything else, once again, is fixed, right? The only change was the down payment, the cash to seller. Everything else was fixed based on the strategy. Income's fixed. Expenses only change because of the debt payment. So now you're making $1,590 a month in cash flow, and you have a cash on cash return of 12.4%. I think that was worse than seller financing. So we said $1,590, 12.4%. So you're making roughly similar amount in cash flow, but you're getting way less cash on cash return. Or you're with subject to, in this particular instance, you're getting more cash flow. Even though the interest rates are the same, you're getting more cash flow through subject to, because your loan amount, like your loan payment, is lower and the loan amount is lower, but that's coming at the cost of putting more money up front, right? In this instance, it's the $40,000 for seller finance versus the 70-something thousand for subject to. And that impact, that little bit of difference in cash flow that you get through the subject to loan, because it's a lower loan amount, is absolutely negated and then some because of the increased entry cost. This is clearly stating that this is a better investment to put less money down into the deal to get a higher cash on cash return. Even if this was, let's say, 4% instead of 3% seller finance, this is still a better deal, right, than taking over the 3% loan. The difference in a lower down payment, even at higher interest rate, is still better for you than if you were to buy it subject to. And this is all assuming that you can even structure these deals that way, right? It's already structured that way. There's different motivation, different opportunities where subject to makes sense and seller finance makes sense. The one caveat here is if you were to do a subject to deal, right, and they have $75,000, almost $76,000 of equity, what you could do is a combination or a hybrid. You can buy the property, and instead of giving them the full $75,000 up front, you can give them a portion of that up front and then seller finance the rest. That is hybrid. You're combining the purchase price, giving them you're taking over this $324,000 loan. You're giving them $40,000 up front instead of the full loan amount, and you're financing the remaining $35,000. These three values still equal $400,000. Difference is when it's subject to, you're paying this full amount. Like if it's a straight subject to deal, you're paying them the full $75,000 up front, which means your loan payment will be lower, but you're paying them a much higher entry cost. Well, if you were to do hybrid, right? So you're doing the down payment to the seller, you're doing the, you're taking over the subject to loan, and you're doing the, and then you're not paying the full amount of equity up front. You're seller financing some of it at 3% and 30-year terms. Your loan amounts are higher. Your collective loan amounts are $360,000, right? And your payments are higher because now you have the seller finance component. However, your entry cost is lower, right? So that's the advantage of if a seller has equity and they're willing to do subject to, well, they're willing to do seller financing as well. You don't have to pay that full amount up front. You can negotiate that amount up front, take over their loan amount subject to, finance the rest of it, and structure a great deal. In this instance, it's saying it's $1,439 in cash flow, 14.6% cash on cash return, right? There's a lot of numbers and a lot of keeping track of things. So I created a separate table that I'm going to show you shortly so that you can understand kind of in these specific scenarios what the deals would look like and how it compares for what we've just talked about, for like very similar to what we just talked about. Similarly to the seller finance loan, there's a subject to balloon calculator, but this is basically telling you for where the loan currently is, what would be the loan amount to be paid off in the full 10 years, right? Like what would that loan amount be? So you can analyze that stuff here. You can, some additional things on here, you can estimate your property taxes. I could do a whole mini training on that, especially how to get those numbers. The main takeaway, it's really important to analyze deals because what it does for you is it tells you, is this even a deal that's worth pursuing? What is the best way to structure this investment? Should I buy it cash, traditional, creative if available? What type of creative? How should I negotiate it? And which management strategy should I implement? Which one of these makes the most sense? Understanding that long-term rental is going to have the lowest entry, but it tends to have the lowest rental income, although it does have lower expenses, right? So maybe your cash flow can be higher or not. It depends on the rental income minus the expense and reserves, and relating that to your entry costs. You're really deciding, once again, should I even pursue property A? Should I even pursue property B? Once you decide, hey, both A and B are good deals, you're comparing, should I buy property A or should I buy property B? And then how should I set up the deal to make it as best as possible? What type of financing should I utilize? Should I buy it cash? Traditional financing? Is creative available? Should I buy, let's say A is better. Should I buy A? How should I buy it? And then how should I manage it? Is it worth putting more money in to renovate, furnish, have extra reserves for your property? Does the new increased cash flow justify the amount I have to put in? This is why it's super important to analyze deals effectively. If you're not doing that, you don't know if you're buying good deals. You don't know if you're buying them as best as possible. You don't know if you're structuring them as effectively as possible. The nice advantage of hybrid is because there's a seller finance component and you're giving the seller some money up front and taking over responsibility of their payments, you can get very creative on how you're structuring the seller finance piece. You could set it up to be 0%, substantially reducing this right? You don't have to give, like, you guys can negotiate on it because you're giving them a lot of the things that they asked for. You can get creative on what you are offering on the seller finance if they're open to it, right? Because you're taking over responsibility of this payment they no longer have to do, and you're adding $40,000 of them up front and another roughly $100 a month, and that gives you a lot more wiggle room, right, to negotiate, because it's not just subject to, it's not just seller finance, it's the combination of things you're negotiating on kind of the whole deal structure. I'm going to show you the comparison. So assuming you're purchasing that $400,000 property for an 8-bed co-living rental, right? Entry costs are going to change based on the amount that you're putting upfront into your acquisition. Cash, it's all of it, right? Everything we just talked about. Income is going to be the same. Your expenses and reserves are going to be the same, except for your loan payment, right? Like, if it's a lower down payment, it's a higher loan amount. And if it's a different interest rate, that's also going to change what the loan payment is. So only things that are changing are entry cost based on the down payment or cash to seller, and the loan amount is changing depending on how much you're putting into the deal, and the interest rate on those deals. Looking at this very simply, there's just another example as co-living. You can compare, really look at the strategy, understand that putting way less money into a deal, right, especially the total entry cost, but putting way less money into a deal allows you to buy more deals, which is extremely beneficial. You put $20,000 in this scenario to buy the deal, you can go buy 10, or this is just for the down payment, right? It still costs $100,000, but it's almost $80,000 less. That's potentially, you're halfway there. You're almost there to buy another one of these deals, right? So not only are you making more on this one deal, but you can go buy more properties, generating you more cash flow, more appreciation, more debt pay down, more tax benefits, right? Like, that's the idea of putting less money in. That's the advantage. You can use that to go buy more assets, and you're getting better returns. So look at it from the cash, traditional, subject to, seller finance, and hybrid scenarios, and look at what is the difference in cash flow, right? You'll see, obviously, cash has the highest cash flow because you're putting all the money in up front. So it has a way higher entry cost. Well, that cash on cash return is 7.8%. Still doesn't hit your overall goal. Traditional, you're putting less down payment, right? Less money up front than you would with cash, but you're also financing it at a fairly high interest rate. So you're making way less cash flow because now there's a loan and a high interest rate. Your entry cost is substantially lower. In this instance, it's still not a great deal. It's a lower cash on cash return than if you just bought it outright with cash. If it's subject to and you're taking over someone's 3% interest rate loan and you're giving them $75,000 up front for that, almost $76,000, your cash flow is higher because your loan interest rate is lower, and your entry costs are lower because you're putting in $75,000 down payment instead of $100,000, right? Even though the loan amount is higher because you're putting less down, because it's a lower interest rate, you're paying less monthly, so your cash flow is higher, and you have a lower entry cost. So both your cash on cash return is increased because your cash flow goes up and your entry costs go down. Both things that increase your cash on cash return. I want you to see this piece again. How do I increase my cash on cash return? Increase cash flow by either increasing income or decreasing expenses, or lower entry costs, right? Typically by lowering the down payment you're putting into the deal when we have this type of comparison. Both of those will increase your cash on cash return, and doing them both will then further increase your cash on cash return, which is what that subject to deal did. Less initial investment, although your loan amount is higher because the interest rate is lower, you're paying less monthly, increased cash flow through decreased expenses, lower initial investment because of lower down payment, substantially higher cash on cash return. Over like right around twice the cash on cash return. Your money is working twice as hard in this scenario than it was in this scenario. Well, if we went seller finance and you're putting in lower down payment, even at a 4% interest rate versus 3%, putting in $35,000 less to buy the deal, even though your loan amount goes up and your interest rate is higher, so your loan payment is higher, so your cash flow is lower, right? So this is, in this scenario, your annual cash flow is lower because your loan amount is higher and your interest rate is higher than it was subject to, but you're having a substantial decrease in your initial investment. That is showing you that's a much better overall scenario. You're getting a 14.1% cash on cash return. Essentially, your deal is working 1.5% higher returns than it was as a straight subject to deal. Take it to the next level, which is with hybrid, right? The combination of subject to and seller finance, instead of giving them the full $75,000 up front, you're giving them $20,000 in the scenario up front. You're taking over the loan amount. Your loan amount is substantially higher, and a component of that loan amount is at a higher interest rate. Your seller finance amount is at a higher interest rate, right? So your total interest rate is 3.3%. Although your cash flow once again went down because there's more loans and at a higher interest rate, at least than it was subject to, the $20,000 decrease in your entry further improved your cash on cash return. How do you figure this stuff out? How do you know if you should, what to do? What's the best way to set up? You have to analyze your freaking deal. You have to analyze the deal. You have to say, if I bought this thing and I put 5% down, like we had in the other example, like, is it better to put, if they're open to it, 2.5% down, or 10,000? Is that better, even though my loan amount is going up and my interest rates in my loan payments are going up? Is that better? Is that worthwhile? As I said, as a rule of thumb, typically lowering your interest rate is the best thing you could do. It's hard to say if just lowering your down payment is always the right thing to do, primarily because lowering your down payment means more loan, which means more monthly payments. So your cash flow changes and your entry cost changes. So like there's two things factoring there. Which one has a bigger impact? You have to analyze and test these things out to know. And this chart should give you a pretty good example of that. Very quickly, I want to talk about how a lot of people make their investment decisions based on year one, which is important because you're trying to figure out, should you buy this deal or this deal? How should you manage it? Whatever. You're looking at your year one returns. That's what cash on cash return and cash flow is focused on, your year one returns when you're making an investment decision, comparing things. Understanding that there's also appreciation, debt pay down, right? The tax savings, all that. You can look at all that year one. However, cash flow and your ownership benefits all increase substantially over time. Not only is this amount increasing, let's say the cash flow, $17,000 and $97,000 over 5 years. If you multiply this number by 5, it's less than this because your cash flow tends to increase with time as your debt payment is fixed. Your debt pay down tends to increase with time as you're going through your amortization, right? More of your payment is going towards lowering the debt. This number is substantially, it's more than 5 times this number. Or an easier example was 10 years, right? 17,000 over 10 years should be 170,000. What's $226,000 of cash flow? Your $8,844 of debt payment is around 88,000 of debt payment over 10 years, but in reality, it's 101,000 because your debt, more of your loan payment is going towards paying your debt down. Appreciation is also compounding. It's not just increasing 16% or 4% a year. That is compounding. That new value is the thing that is increasing over time. So as your value of your property goes up, so does your appreciation. So instead of a 16,000 or 160,000 appreciation over 10 years, it's 192. Tax benefits are the exception, where your depreciation, the main tax benefit, is fixed over that 27.5-year time period, or you do a cost segregation study, accelerate depreciation. You can get that in a shorter period of time, get more tax benefits in 5 years instead of 27.5. But the interest payment, for every dollar your debt payment is going up, your interest payment is going down. So this one actually is going down over time, primarily because, like the amount, right? This 10,000 over 10 years should be 100,000. What's 93? Because you're paying more towards the principal. Objectively, any person you ask, they'd rather have more money going towards paying down debt. That's an actual dollar added to your net worth. And you sell that to tap into that, or you refinance and pull that money out tax-free to tap into that. Whereas your tax savings only offset your income and only a portion of your income. You don't actually get almost $200,000 of tax savings. That tax savings impacts your tax payments based on your tax bracket in which it's impacting. So that $200,000 is effectively $67,000 of actual tax benefits when you account for like how it directly impacts you. But every dollar added to your debt paydown is actually added to your debt paydown. So with that, I'm going to quickly share a couple key other things, right? Your long-term analysis, this is how that's determined, right? You set what you expect your rental growth amount to increase over time, what you expect your tax and insurance, utilities to increase over time. You set, or just stick with the presets. Your property management, vacancy, and maintenance and capex are dictated by the management strategy that you select. The management strategy that you select in the deal analysis tab, the main tab, and it is a percentage of your total income. As your income goes up, so do these dollar amounts. Even though the percentage stays the same, the dollar amount goes down. Your entry cost, well, that's year one entry cost, right? It depends on the management strategy you implement. That's your year one entry cost. Your property value, right? It's pulling from your purchase price, and you're saying what percentage do you think it's going to appreciate over time? You dictate what you think that is. 4% is fairly on par. If you're being really conservative, you're doing around 3%. If you're being more aggressive, you're doing around 5%. Understanding that some markets appreciate substantially more, like my San Diego market versus my Atlanta markets, which are much more average, and some markets are appreciating substantially less. These small town, little property, like these little properties don't tend to appreciate a lot because there's not a lot of economic factors increasing property values because there's not a lot more people's income is not substantially rising. A lot more people are not moving into that area. If anything, it might be going backwards, right? So these small towns not only give you less cash flow, less cash on cash return, and less ownership benefits. They give you less ownership benefits because your properties are worth less and your properties tend to appreciate at a lower percentage and a lower amount. Like if this was instead of 400,000, this is 16% appreciation year one. If it was 100,000, this is $4,000 appreciation, right? It's got cut down to 25%. So you have lower appreciation. If the loan amount, right? If the loan amount went down because your property is worth less, it's a lower cost property, there's lower debt, the debt payment will go down, right? That your tenants are doing on your behalf. That's why I prefer the co-living strategy, because I'm able to buy bigger, better properties that are in nicer areas, that are in better, they're in better states, in better parts of the state, like major cities. These are areas that appreciate more. These are areas that have a much higher demand, which means there's much higher cash flow, which means there's less vacancy, there's more appreciation, because more people want to move there. Obviously, that's why affordable housing is a necessity. There's more investment opportunities in that area. There's more resources in that area when I need property managers, contractors, cleaners. Like there's more people to tap into at more competitive pricing. That's why I do co-living. It's just the best strategy currently when it comes to these single family investment opportunities. So you get the long-term analysis, you get to see what your overall returns and all that look like over a long period of time, over the full next 30 years. But also, if you are buying this deal, this co-living deal that is hybrid, right? And you need $118,000 to get into the deal. Well, here's the total returns on the deal. If you are raising money from a private money partner and you're splitting ownership, they bring the $118,000 and you are offering them a 40% ownership percentage. That means this is the cash flow they generate. This is the total cash flow they generate. This is the debt payment benefits they get based on their 40% ownership and cash flow, the appreciation benefits they get, the tax benefits they get. This tells you their total returns for that investment year one are $19,701. Their total cash flow year one is $6,907. $6,907 year one divided by their entry of $118,000 is this 5.8% cash on cash return. The total returns, which is accounting for all the benefits, cash flow, taxes, appreciation, debt pay down, is $19,701. That divided by the $118,000 is telling you a 16.6% cash on cash return. To the best of my understanding, no one else is freaking calculated does this for their own deals, especially this nuance, especially not dividing it for what your private money partner, your co-owner gets for putting in that money and what you get. If you want to see, like if you know your capital partner wants a 7% cash on cash return, you need to meet that number. Okay, well, if I increase let's say you keep the ownership at 40%, but you increase your cash flow to 50%. Well, now you're at 7.3%. Let's say you do both 50% ownership, 50% cash flow. They can be the same ownership and cash flow split. They could be different. It's ultimately up to the way you structure your deals. But let's just say it's a 50-50 split. They bring in the 118, you split it 50-50. They now get their 7.3% cash on cash return, which is what they wanted. Almost a 21% return on investment year one. This is how you decide how much should I give up? What are your partners looking for? And then this will quickly tell you, does 30% work? No, it's too low. 50% work. Cool, now we hit the numbers. Or if it's 40%, you can say, I'm going to put in $30,000 of this. I'm going to put in $30,000 of my own money. So my returns will no longer be infinite because I'm putting in some of my own money, but I'm putting in 30,000, which is, it is roughly 25% of the entry cost. I guess I could have done that in my head, which means now they're putting in roughly 75% or 88,000. You're putting in 25% of the entry cost, but you're getting 60% of the ownership. Well, maybe you don't have infinite returns, but because you're getting so much more, you're getting a substantial amount of cash flow and ownership, your returns are substantially higher in this scenario. It's not infinite, but it's 34.53%. Even though the deal itself, if you were the one to put in the entire capital for the deal, would be 14.6%. Well, this deal now makes sense for both you and your partner because you are putting in some of the money. You're getting way more ownership and cash flow than the amount you're investing, which is why your portion of cash flow is substantially higher than it would be just for the deal outright if you used all of your own money. Same with their private money partner, right? If you put in no money, they'd be at a 5.8% because they're getting this amount of cash flow for the putting in this full amount. Well, if they're still getting the same amount of cash flow, but they're putting in $30,000 less, their cash on cash return is higher, their return on investment is higher. This is how you get deals done. When people say, they reach out to me and say, Michael, I have $100,000, $200,000, whatever, a couple $100,000, even 50, whatever it is, to invest in some deals. And they start asking me about how to make the most of it. This is why Super Investors makes a lot of sense for people. My own mentorship makes a lot of sense for people with more capital because I can help you take that same $100,000 and instead of just buying one deal using your own money, potentially generating you a 14.6% return, I can teach you how to raise capital. I can teach you how to buy this deal using none of your own money, getting you infinite returns, or spread your $100,000 that you're going to put in $30,000 for each of those properties, get three phenomenal returns, get three phenomenal properties that generate you solid returns with that same amount of money, right? You invest in a little bit of education and mentorship. You understand all these skills and tools to be able to raise money, structure creative finance, master co-living, and then set up your deal so your money works harder for you. Unfortunately, sometimes I talk to lots of people who spend their full $100,000 beforehand, before we ever talk and before they think this might be a fit for them. Now they've bought the wrong deal because they didn't analyze effectively. They're losing money, or they're not making nearly as much as they thought, or they squander the opportunity because it takes a lot of time for some people to save $100,000 if they're ever able to. That same $100,000 could have got them the education, tools, resources, mentorship, community, all that stuff to then be able to scale, but also to take that same amount of money and buy multiple properties through combining capital raising and their own money, which makes it a lot easier for people to raise money on their first few deals. Just wanted to show some of this stuff to show you there's various ways to make it work. The reason why this calculator is powerful is once you get your deal, you can then play around with this to say, what am I going to give up? If I'm going to put in my own money, what do the returns look like for everyone? This does it for 1 year, 5 year, 10 year, and 20 year projections, which is important to show not just the year one, but what are the long-term projections on this investment? Similarly, if you decide to get a private money lender, instead of someone bringing in the money to co-own the asset with you, they're just giving you a loan at a fixed interest rate return. Does this deal make sense for you? Well, if they provide you the $118,000 at 12% interest rate return, you're paying them $14,000 of interest a year. That leaves you with $256 a month of cash flow or $3,000 of cash flow left over, right? Your total cash flow minus what you're paying them is what's left over. Your returns are still infinite, right? Because you're putting in none of your own money to buy a deal that generates you positive cash flow. The one issue with private money lenders, like getting private money loans on buy and hold investments for large amounts of capital, is you have to figure out how you're going to pay them back this $118,000. If they're willing to give this to you for 60 months for the next 5 years, well, this $118,000 is not as important to consider, right? I mean, you still have to figure out how you're going to exit them in 5 years. You're going to get the benefits of debt pay down, appreciation, and this cash flow you're going to generate over that time period that you can pay them back, and you were able to maintain 100% ownership, 100% cash flow, even though you're taking that cash flow and providing them a substantial more amount of money as the lender, and then have to give have to figure out how you're going to pay them back this $118,000. This is why this is nice. But more importantly, you take this, you plug it into the stuff I teach you, like I teach super investors when it comes to capital raising, and you just take a quite literal screenshot of your analysis, breaking down all the important information. Here's how much we need. Here's how it's broken down, all automated. Here's what your returns would look like based on what you put in the deal analysis calculator and the using other people's money tab. All you got to do is screenshot this and put this in your capital raising presentations that I provide you, all those templates. After you learn how to, raise capital, structure great deals, maximize the returns, and you plug it into the templates I provide you to raise capital, to share your deals so that they get funded quickly, and your capital partners have a phenomenal understanding of what's in it for them. What's the deal look like? What do the returns look like? What's all that look like, especially what's in it for them? And you plug it into the CRM I provide, the Super Investor CRM, so that you can now blast it out to all of your potential capital partners that you're able to bring into the fold through the capital raising form that you get your own custom form for, that brings all that information into the CRM, so you can now share this information easily. You've analyzed the deal, you know what you're going to offer, you've got this screenshot, you copy it, you put it into your capital raising template that you're provided, you take that, you share it through your CRM, which has all your capital partners seamlessly in there, so you get it out to as many people as possible. The template is structured to answer as many questions as possible. Pre-think what are the questions your capital partners might have, so it's less back and forth. They can just quickly and immediately say, yes, I want to buy this deal, or partner with you on this deal, which is my experience. Within 12, 24, 48, at most 72 hours, we're getting our deals funded because I'm giving them all the answers, not a ton of inefficient back and forth. They don't feel like I'm trying to mislead them or not include information, like it's there for them. And it's all seamless, so you can spend your time and energy finding more capital partners, finding more great deals, not wasting all the time and energy on trying to do all this stuff manually. This is the only calculator. This is the only tool that does literally all of this stuff for you, from being able to analyze various ways to acquire, detailed breakdown of entry costs, various management strategies. If you were to raise money for your deals, what that would look like, analyzing them over long-term, but not just for cash flow, but also all of the ownership benefits involved. Simple layout of for private money lenders, for private money partners. Understand the debt for both sub 2 and seller finance. In this, I don't even touch on the complexity of this, because this is not a brand new loan. You have to have a tool that understands you're buying this loan started in 2022. We are buying it, and right now it's 9/1/2025, or you bought it in 6/1/2025. It needs to understand what is the current balance, what is the interest payment currently and moving forward from that date of purchase, what is the principal amount moving forward from the date of purchase, not just from the original loan. I don't think anyone else has been able to code it the way that I have, so that it's seamlessly doing all that for you, not just a brand new loan. So with that's it. I mean, hopefully you understand why your number one job is to find, if you're a real estate investor, you understand why your number one job is to find great investment opportunities and be able to decide what are great opportunities, differentiate between the different opportunities, which one's the better one to buy, how should you structure it to maximize your returns if possible, how should you put in more money to implement a more advanced strategy, does the entry costs for the advanced strategy, short-term, mid-term, co-living, make sense, right? Does putting more money in make sense for the additional cash flow? You could do all that on this calculator and then analyze the deal in full for all those strategies, compare everything, have some automatic renegotiation done for you, understand what capital raising, what that impact is, and have a lot of flexibility in how you structure it, understand the deal long-term, get the deal analysis automatically provided to you. I give a free version of this calculator, which does a lot of this, but it doesn't go into the long-term analysis, using people's money, or any of these templates. You can do all the same analysis for the deal year one. You get the amortization schedule, all the power of sub 2 and seller finance, like the long-term, the amortization schedule for it. All you got to do is go to my Instagram. Go into my Instagram at Michael MNAT, click this link. You go on my Instagram, very simple, Michael MNAT, free investing tools, sends you to this page. From here, I link my free community called Wealth Through Real Estate. I link my YouTube with super detailed trainings just like this one. You can get free access to the calculator, but just putting information here, get instant access. You can see the types of deals I'm buying and what I'm looking for. You get free trainings if you want to bird dog for me. If you want to find deals for me and get paid for it, you get free trainings on that. You can learn a little bit more about my Super Investors community and apply for it if you are someone who feels good with how much money you are making relative to how much you are spending each month, right? Your active income is exceeding your monthly expenses. You're not going into debt every month. You have little to no bad debt. You have reserves set aside, and you're ready to be more of an advanced investor, leverage capital raising, creative financing, and the co-living strategy, and learn how to do all of that step by step by the person who does it probably better than anyone else. With all that collectively, you can apply for that and see if you're the right fit, right? And I can help you scale your portfolio, especially if you're someone who has $50,000 or $100,000 or more ready to go. Please do not squander your opportunity. You've already spent a lot of time saving and investing that money, or like saving that money ready to invest. Don't waste it on a bad deal or put too much on one deal when you could have just invested a little bit of that towards education to get all the tools, resources, and support that you need to be able to take that same money and be able to buy an infinite amount of deals through capital raising, or substantially higher return deals through creative financing, co-living, or using a portion of that money to, like the 30K example, use that same 100K to not only get educated to do this over and over again, but to be able to go buy multiple more properties with that same amount of money, right? Instead of buying one, maybe you can go buy multiple with that same amount of money. Don't waste your opportunity. You've already done the hard part of saving, which the majority of our country is not capable of doing, right? That's just a matter of fact based on the stats. When you go to my free Wealth to Real Estate community, if you are already part of it or not, you just click that link. Just sign up if you're not part of it. We have over 1,700 awesome members in there. And you go to the classroom, you get tons of free trainings. You get understanding financial freedom. You get analyzing investments traditionally. You get analyzing investments creatively. You get access to the calculator, which I already provided, but it's also linked there. You get various free courses, tools, and resources in here to help you on your journey. So if you're not the right fit to apply for Super Investors, don't worry. You don't need to. If you are, DM me or just click the application link and fill it out, and I can see, we can have a discussion, see if it's the right fit for you and you're the right fit for it. If not, if you're not in the right position, take advantage of all the free tools and resources that I've created, all the things I wish people provided me when I was starting my investment journey. Remind me the clarity that I needed, the strategies that I needed, the ability to find deals, analyze deals, make good investment decisions, all the tools and resources to do so. These are all the things I wish I had when I started learning 7 years ago. When I bought my first property 5 years ago, well, instead of keeping it with me and saying, hey, it's all mine. Sorry, everyone. I share all this and I help so many people, thousands of people for free to help you on your investing journey, regardless of where you're at. If you have more capital, you're ready to scale, well, cool. I can help you take that money you have and get way more done with it, and help you get financially free way faster. So with that, that's all, guys. I appreciate you. We went super long on this. I hope it was a ton of value for you. Make sure to analyze your deals. Make sure to grab a free copy of the Super Investor Real Estate Calculator. If you want the more advanced version, reach out to me, or you can just buy it on my website. Or if you join Super Investors, that's one of the many tools that you get. So with that, thanks, guys. I appreciate you. Have a phenomenal rest of your week. For those of you that I'll see in the San Diego meetup, I will see you this Friday. We're going to have an epic meetup at one of my incredible short-term rentals in San Diego. Expecting maybe 100 plus people, so make sure to register for that. If you don't have the link, here's the link to register for that. For the meetup, and for those of you attending my co-living workshop, I look forward to seeing you there and providing you an insane amount of value and helping you just maximize your investing journey through the co-living management strategy. So with that, thanks, guys. Have a phenomenal rest of your week.